You ever look around and wonder how some people seem to make money without really doing anything? I mean, while most of us are trading our time for a paycheck, they're somehow getting paid just for owning stuff.
Right? It's that friend who just casually drops that they made a few $100 last month without lifting a finger. Or maybe it's that neighbor whose investment portfolio just mails them checks every few months. You start to think, wait a second, did they find some secret money tree that nobody else knows about?
Well, here's the good news. They didn't find a magic tree, but they did find something that's honestly almost as good. They found the world of dividends. And once you pull back the curtain and see how it works, you realize it's not some secret club at all. It's actually a super powerful and accessible tool for making your money finally start working for you. So how does this whole thing work? Look, this is far from some secret trick. This is one of the oldest, most reliable ways people have built real wealth for generations. So let's break down exactly how your money can start working for you instead of the other way around. Okay, so picture a successful company. It's making a profit. It really has two main choices for what to do with that cash. Now, if it's a young, hungry startup, you better believe it's going to pour every single dollar back into the business to grow faster. But what about a huge, established company that's already kind of conquered its corner of the world? Well, that's when they decide to share the wealth.
And that whole idea, sharing the wealth, that's the core concept we need to get our heads around. So let's just dive right in. A dividend is, put simply, just a piece of a company's profits that it hands out to its owners. And who are the owners? The shareholders, you. It's the company's way of saying, hey, thanks for believing in us, thanks for investing your money with us, here's your slice of our success.
And you know what's funny? You already understand this concept perfectly. Think about it. You put your money in a savings account, and what does the bank do? It pays you interest for letting them use your money. Well, when you buy a company's stock, you become a part owner, and they pay you a dividend for letting them use your capital. It is the exact same principle. So who are these companies we're talking about? Well, they're typically not the flashy, high-flying startups trying to become the next big thing overnight. No, we're talking about the giants, the mature, stable, blue-chip companies. Think of massive, reliable, household names. You know, Coca-Cola, Johnson & Johnson. These are the businesses that have basically perfected the art of making consistent, predictable profits year in and year out. Okay, so that's the theory, but how does the money actually move from their bank account into yours? Let's just walk through a super simple example. Let's make this totally real. Let's say you invest $5,000 and buy 100 shares of a company. Now, that company announces it's going to pay a $1 dividend for every share you own every quarter. Well, you own 100 shares, so that's a $100 check showing up in your mailbox every 3 months. Simple as that. It all adds up to $400 a year. That $400 on your initial $5,000 investment, that's an 8% cash return. And here is the absolute magic of it all. You didn't have to sell a single share to get that money. Your original investment is still sitting there, hopefully growing in value, while also sending your cash. It's just like owning a rental property that appreciates over time, but also sends you a rent check every single month. But hold on, because it gets even more powerful. See, most companies will let you automatically reinvest those dividends to buy more shares. And this creates what investors call a dividend snowball. Those new shares you just bought, they start earning their own dividends, which then buy you even more shares, which then are even more dividends. You see? It's this beautiful, powerful cycle that just gets bigger and bigger over time. So you get the concept. You're probably thinking, okay, I'm in. This sounds awesome. But how do you actually, do it? Let's look at a couple of smart, practical strategies. You've really got two main paths here. On one hand, you can do all the research yourself and try to pick individual winning stocks. It's higher risk, for sure, but potentially higher reward. Or there's a much simpler approach. You can buy a dividend-focused ETF or an index fund. Just think of these as big baskets that already hold hundreds of different dividend-paying stocks all at once. It's kind of like buying one slice of every single pizza in the city. You get instant diversification with way less effort. And within that world, there's this elite group. They're called the dividend aristocrats. Now, to get this title, a company has to have not just paid, but increased its dividend every single year for at least 25 years in a row. Think about that. Through recessions, market crashes, global pandemics, they kept raising the dividend. That isn't luck. That is a massive signal of an incredibly durable business and truly world-class management. That's what reliability looks like.
Now this is so important. What should you look for? A stock with a super high dividend today or one with a smaller dividend that's growing fast? Look, beginners always chase those high yields, but the pros, they focus on dividend growth. A 3% dividend that's growing by 8% a year is like planting a tiny oak tree. A stagnant 6% dividend is like picking a bouquet of flowers. Yeah, one looks better today, but the other one is what builds real generational wealth. Of course, like any investing strategy, it's not all sunshine and rainbows. There are definitely pitfalls you need to watch out for. So let's cover the big ones, so you can invest a lot smarter and avoid some really common rookie mistakes.
Okay, first up is the big one, the high yield trap. If you see a company paying out a 10%, 12%, or even higher dividend, your first thought shouldn't be, wow, what a great deal. It should be, wait, why? More often than not, that sky-high yield is because the stock price has absolutely cratered. It's kind of like a restaurant offering a 90% discount on all their food. You have to wonder why they're so desperate for customers. It's usually a red flag.
So a really key safety check is something called the payout ratio. It's just the percentage of its profits a company is paying out as dividends. Now, if a company is paying out 90% or more of what it earns, there's just no room for error. When that year and that dividend is in trouble. The sweet spot is generally in that 30 to 60% range. That shows the company is generously sharing profits, but also keeping enough cash to handle tough times and invest in its future.
Okay, this next one confuses so many new investors. It's the day the dividend gets paid and they see the cash hit their account. Awesome. But then they look at the stock price and see it's dropped by almost the exact same amount. So the question is, did you just lose that money right back?
The answer is a big fat no. It's just a simple accounting adjustment. The cash is no longer inside the company's bank account, it's now in your bank account. That's it. It's like taking $20 out of your wallet and complaining your wallet is lighter. Of course it is. The money's in your pocket. This is why successful investors never just look at the stock price. They focus on total return, which is the stock price change plus the dividends you received. That's the only number that tells the whole story.
So let's just end with this thought. Dividends, they're not magic. They're not a secret. They are simply a company sharing its success with you, its owner. And when you start to think of it that way, every payment that hits your account is like a little thank you note from your investments, rewarding you for your patience and your belief. So the real question is, are you ready to start building a portfolio that actually thanks you back?